attracting and retaining the key associates. That's we use culture, mentorship, and then you use the equity buy-in to really retain things. And that's kind of your guys's ace that you guys hold, that you've built out and done a great job with that and helping folks with that. So then you said, and if you're okay with this, you said the second thing was banks become reluctant with the money, right? So they're more than happy to give financing for that first practice, no problem. And that's pretty much a yes to everybody. But now you're moving past that $2 million mark. How do you solve that? Where do you guys go to solve that? And I know I work with you on several accounts in DeWalker as well that have 10 or 20 locations. How are you walking through and solving that with them?
Yeah, so it's really from the lender's perspective, this comes back to something called concentration risk. And concentration risk is that banks don't like to have a large amount of loans outstanding to one borrower. In case that one borrower goes under, it creates a negative impact on the lender. Okay, so when I say they hit a ceiling around $2 million, that's not a hard number. It kind of just ends up being around that number typically that we see. And there's a very real reason for it. And it's not that banks aren't good at what they do or they're being
they're being actually really good at what they do, right?
Oh,
banks
completely.
The banks protect their money and protect their investment.
Right. Yeah, banks are conservative for a reason, and we all, as consumers, we want them to be.
Yeah,
it beats the alternative. So the challenge becomes, and what we typically see is that so a client will come to us with, let's say, 5 locations, and when we build and they've acquired or built or bought 5 locations within a relatively short period of time. So what we'll see when we build a financial model is that bank number 1 loaned the money for locations 1 and 2, and then they pull the string on them, but the dentist was hell bent on acquiring location number 3, so they went to a different bank to fund the purchase of location number 3. And oh, by the way, that second bank, agreed to fund location number 4. And then they put the brakes on it, but they had to have location number 5. So they went to a third bank, like a municipal bank or something like that, a local bank, for that 5th location. So now they got 5 locations and 3 different lenders. And when we look at this, this is a structure called subordinated debt. So locations 3 and 4 with the second lender carry a slightly higher interest rate and probably usually more of a greater prepayment penalty. And the third lender that funded location number 5 has an even higher interest rate and carries an even more extreme prepayment penalty. There's probably in the covenants from the initial lender on numbers 1 and 2 in the covenant structure, a covenant that says that the borrower cannot take out any subordinated debt without prior approval from the senior lender. And I can tell you that I would be really generous to say that 9 times out of 10, the borrowers don't read the covenant structures. It's probably more like 99.5 times out of 100.
Well, yeah, because it's like this big of a piece of paper.
Yeah, exactly.
Paper, yeah.
So technically, they're in violation of the agreement with the originating bank.
So is this just as simple as, and again, just for me, who I've never taken out a loan to start a clinic or a dental office. So is this just as simple as, like, I get a first loan on my house, and the first loan on the house says you got to get permission to get a second loan on the house, and I just go and take out a second loan and don't tell the first loan? Is it that?
Well, it's similar to that, but it would be if your primary mortgage company for some reason said that you couldn't buy a vacation home unless you mortgaged it through that primary, they wouldn't do that, but that's kind of the theory, loosely termed there. And again, that's to protect the initial bank from a credit risk profile. So this is not so. The reason to illustrate this point is because eventually when entrepreneurs pursue this strategy of just finding another bank to fund each location, the shell game ends at some point, and you can't get more funding for additional locations, and the game's kind of over. The that's the problem. They've been seeking what we call retail lenders that are rate and term, really usually low cost of funds, 10-year terms. They haven't looked for business to business banking that says, let me take a look at your business plan. What are you
Mm-hmm.
trying to build here? You're trying to build a 10 location group and you want to buy 3 locations a year over the next 3 years or something to that effect. Well, what does your business plan say the revenue projections are? What's the EBITDA? How frequently do you want to deploy this capital? What's the end game here? So you haven't really sat down with a true business to business lender and laid it all out for them.
Mm-hmm.
And
And how
when
deep do you guys go into that to help these clients? Like if I'm a dentist and I'm like, okay, I'm on location 2, I need to figure this out. I don't want to go to my third bank to get this loan because it's really not going to put me in a good position. Where do you pick that up and
Yeah,
then hand that off?
I would say that probably about 40 to 50% of the clients we work with, about 1 out of 2, um, we encountered this situation, and it it might not you might not hit a debt funding wall if you want to buy a new practice, an additional practice every 2 years. Banks may be perfectly comfortable with that. Um, that being said, I don't know many entrepreneurial dentists that are looking to buy another location every 2 years. It's more like 2 every year.
Yeah.
So that's the rub. So it's not just that banks are bad or retail lenders aren't the way to go. They might be, depending on the pace of your growth strategy and
Mm.
also the target that you're looking to acquire. Is it $1 million practice? Is it a $300,000 practice? We want to get behind all those numbers, and we want to understand the real volume of funds that it's going to take to execute that growth strategy and how fast you want to deploy them. And then at that point, we've built the financial model of the business and the 5-year growth pro forma. So what does the next 5 years look like? Well, Perrin, I'm going to acquire 2 practices per year. Each one's going to be an $800,000 purchase price. It's $1 million in revenue and 200,000 in EBITDA. And we kind of lay all this out in a stair step method over about 5 years and say, okay, here's where the bank's going to cut you off in year 3 because you've exceeded your leverage ratio in the following ways and parameters. We need to find a lender that's going to fund the vision that you have for the business and give you the credit facility. It's kind of like line of credit, right? They're going to give you the credit facility that renews every year as long as you continue to operate the business the way you have. And if we
And
can do that, then it's a secured source of funds that can take you to the finish line. You should never outgrow it.
got it. And then how important is the relationship with the bank on that front? Is that like the key component, is that you're building this relationship with them and they understand your vision and where you're going and they can get behind it? Is that basically what you're looking for?
Yeah. So let's redefine the term relationship, okay? Because this is a really good question. And I was about to jump in, and I'm glad I didn't to actually listen to your question. So um, you and I think about, and most dentists, when they start out, think about relationships in the terms of who's going to take me to play golf this weekend? Who's going to buy me a steak dinner once a year? Every banker says they want to be in a relationship with you. What they really mean is they want you to do your business checking with them, and oh, we can get you preferential rates on a home mortgage. We're in a relationship with you and everything like that. That may be true up to a point. Business to business banking is about business, and it's about business relationships. It's not about playing golf, and it's not about going to Del Frisco's and having a nice bottle of wine together. Okay. It is about the health of the relationship in a business context. So are they relationship uh, people? Absolutely, around the context of the business you're trying to build. So Do they want to know about you, what your vision is, what makes you different? Do they want to know the numbers behind the numbers? Do they want to know what the next 5 years look like? Yes, they do. They want to know the subjective piece. They want to know the objective piece. And the credit officers are super concerned about how you're going to deploy their funds and how you're going to continue making payments on time, all the time, with a great degree of um, buffer, if you will. Okay. And that buffer is called debt service coverage ratio. So if they sign off and say, you know what, Gary, we love the business you've built. It looks really good. We love the business you're building. We want to be in a relationship with you. That relationship means we're committing to you to continue to fund that business every year as long as you continue to operate the business as well as you have.
Yeah.
And these are credit facilities that probably span somewhere between, on the low end, $3 to $5 million, and on the high end, I think we just closed or about to close one for like $25 million. So if positioned correctly for our core client, they should never run out of debt funds. And the only reason they should leave this lending institution is because they chose to go the route of private equity and bring in a capital partner at that point, but not because they couldn't secure the funds to continue to grow. And that's a much better way of operating the business, because it's like having conditional pre-approval. You know the funds are there. Go find the businesses to buy. Don't go find the businesses to buy and then pray to God that the bank approves it.
Yeah.
All right. That's backwards.
That's not a good model. Yeah.